Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth for the Inside Network. Joining us to explore the role of asset-backed securities in offering resilient income is Lauren Ryan from Thinktank.
Hi, Laurence. How are you going?
Very well, thanks. So it's a really interesting time, Lauren. We've seen the rates reset really quickly. And now that means that on the nominal level, some of those term deposits, some sovereign bonds are looking quite attractive. And yet for investors, those that are dealing with higher costs of things like healthcare, food, there's inflation across a number of those goods and services. The balancing act is that they have to think about their portfolios. What can asset-backed securities, what role can they play for the savvy investor?
Yeah, it's a really interesting time for fixed income and for credit markets, because with the increase in official interest rates that sort of started around 2022 and the quantitative tightening that came in, we're starting to see quite attractive yields in the fixed income and credit space. Of course, on the flip side of that, it means that there are borrowers who are paying higher rates, and with the overall increase of cost of living and inflation, the consumer, the borrower, we're all under a bit of pressure. When it comes to asset-backed securities, and Thinktank specifically issues residential mortgage-backed and commercial mortgage-backed securities, investors are exposed to quite a diversified pool of mortgages, so they don't have single asset risk within that space. And in many cases, they're able to generate quite attractive equity-like returns whilst taking the debt risk, which hasn't been the case for quite a long time. As we always say in funds management, diversification is key, and having that exposure to a very large pool of small ticket loans in Thinktank's case offers that diversification, which is quite difficult for investors and expensive for investors to obtain themselves. These transactions are predominantly available to institutional investors, so retail investors like yourself and like myself can't actually access these directly. So by investing through a fund or directly through a product provider, such as what Thinktank does, offers investors exposure to a market, a diversified pool of mortgages type market that they really can't get themselves directly without quite a large expense. Compared to, say, other corporate debt, ABS, CMBS and RMBS, they actually pay down principal as well as interest. So the RMBS program amortizes principal over time, whereas corporate bonds generally pay interest only, and a bullet payment of capital, or even a government bond will do the same, a bullet payment of capital at the end. So from an RMBS investor's perspective, your risk is declining every time that principal is being repaid. Generally, these transactions, the ABS transactions, they have a bankruptcy remote vehicle, or they're structured in a way that if the issuer becomes insolvent, a trustee will step in and continue to collect on the debt and repay investors. So investors have that third-party protection, whereas when you invest in a corporate or government bond, the default risk of that corporate or that government is really what you're relying on, in that you've done the due diligence and you're getting paid appropriately. And whilst there are assets within the business, you're kind of relying on the fact that corporate the going concern will continue, and that they will be able to repay you in time. And depending on what those assets are, if that corporate didn't exist in the future, then those assets would either be 100% or zero. So that's another added benefit to ABS, RMBS and CMBS transactions for investors.
It's a brilliant answer. You've captured a lot. Going back to the first point, which is that there are higher borrowing costs, which affects everyone. That affects residential mortgages. It also affects any of the commercial mortgages that you look at. How are you looking at those costs? Because presumably it's making your due diligence a little bit harder. Are there spaces and sectors that you're looking to avoid?
Yeah, look, a lot of borrowers, all of us really, have experienced those challenging circumstances, increasing costs, and it's hit all markets relatively in a relatively similar way. We don't look at excluding any particular sector. We are always concerned about how high interest rates will impact the construction sector and certain parts of the retail market. Thinktank's a small ticket lender, so our average loan size as at the 31st of March 2024 was $600,000. Our average LVR is around 66%. So we are exposed to lots of small mortgages. So assets like large office towers or large retail centres that might be a little bit more volatile in different rate environments, we don't have exposure to those. Our borrowers are predominantly SMEs, SMSFs and self-employed borrowers. We all know that that part of the market, as well as all consumers, PAYGs as well, have been hit with the increase in rates. So the portfolio has experienced some stress, which is what we'd expect, because if we hadn't, then the governor would keep raising interest rates. But we've been able to help those borrowers where we can and get them back on track. And thankfully, the property market has held up quite well. So people who do fall into trouble, they're able to sell their properties and potentially make a gain or at least get back their equity. So we're not seeing properties being sold once the borrower gets into stress at a loss, which is promising. And we've got low unemployment, these are all factors that are helping. So whilst there is a lot of stress in the economy, there are a lot of positives that have come out of it as well. On the commercial side, Thinktank's portfolio is on the commercial part of our book is 51% industrial. That's probably the one asset that has really bucked the trend since 2019 and 2020, it's quite funny how different market cycles can completely change the attractiveness of an asset, because for people that remember industrial assets before we started locking down, they were not that attractive. And office towers were really the cream of the crop. That has obviously turned. 51% of our commercial assets are industrial. So we have office retail, but again, they're small tickets. So you're looking at the cafe, the restaurant, the barber, a strated office, and we look at assets where lots of different tenants and lots of different purchasers would be able to move into that premises, rather than one single asset like a large office tower, which is most likely only going to be a large office tower, or specialised assets where your risk is increased. We generally don't play in that space. And Thinktank doesn't have exposure to development or vacant land or land banking. So all of our assets are income producing assets, and being small ticket commercial and residential, we've got a lot of different buyers, a lot of different tenants for those assets. So to answer your question in a succinct way, yes, we have seen pockets of stress, and it's been systemic across the economy. We're not looking to exclude any particular assets, but we're always cautious of construction and retail.
You've captured so much of the thinking around diversifying your risk. So another component, which you've touched on, is you're aggregating lots of these small loans. That's also at a national level. What does that do in terms of offering protection for investors?
The diversified pool, as I said before, it's quite difficult for investors to obtain that level of diversification on their own, or it's very, very expensive. So there will be direct property investors out there who might have 3 or 4 direct holdings as well as their own home. That's quite an impressive portfolio. Very few investors actually have that many loans. In terms of diversity, one asset for 25% of your portfolio, most fund managers or asset allocators would not be comfortable with that level of diversification or lack thereof. Now, of course, in direct property, you have control. So that's a very different game. If you're looking to place your capital with somebody, the more diversification, the better. And because all of our loans are secured by existing property, commercial and residential, if the borrower is unable to pay, we're able to take possession of that property, or they're able to sell that property. And being a debt fund, we get paid first before the borrower's equity is returned to them. So strong employment, relatively low arrears, considering what we've experienced in the last sort of 2 years, and strong property prices are the big protectors for investors' capital at the moment. But as we often say in this industry, it's all about diversification.
You provide that naturally. It's a very smart solution. And then just one final component, there's clearly low risk opportunities. This is further up the scale, but so much rich thinking is done to reduce that. What role do the ratings agencies play in this market?
With our CMBS and RMBS transactions, when we issue those transactions into the debt capital markets, our market is institutional investors, and generally their fixed income mandates dictate that they can only invest in rated notes. So that really is what drives the ratings. As with financial advisors, individual investors, institutional investors, the ratings are a piece of the due diligence. They're an extra piece of information. They're not the be-all and end-all. And that's how our institutional investors use those ratings. We get our transactions rated by S&P, Standard & Poor's and Fitch. That's sort of the role the credit agencies play and why we get those transactions rated.
You've touched, Lauren, on the democratization of this as an opportunity, traditionally sort of owned as a landscape by the largest investors like the pension funds. The cynic in anyone would sort of think, well, maybe they get, with the relationships they have, the choice of the opportunities that come up.
Yeah.
Is that fair or unfair? Because it sounds like you're offering investors that are now at that sort of high net worth opportunity set, they're able to get exposure to something that's traditionally only been institutional grade. Are they still getting the same access?
Yeah, so that would be an unfair statement, and I'll explain sort of how all that works. So the way that Thinktank operates, our debt facilities are what we call a debt warehouse or the debt capital stack. The senior funder who takes the AAA notes, the senior funder in all of those positions, they set the credit policy and they provide 85% of the first mortgage capital. So let's say, for example, Thinktank has a $500 million facility. The senior funder won't give Thinktank all of that facility. They might say, we'll give you 85% of it. We require, and they are able to do that at quite a tight price, which is how funders like Thinktank and many other non-banks are able to keep their costs of funds within reason. They require subordination. So subordination essentially means that the senior funder requires first loss protection to sit underneath them. Mm-hmm. So Thinktank will go and negotiate with another institutional investor to take the mezzanine or the junior tranche. So if you imagine the debt capital stack like a ladder, the first rung is quite large and it's taken up by the senior funders. Mm-hmm. The second rung is a little bit smaller and that is taken by another institution, but they take the mezzanine or the junior tranche. And then the last rung is smaller and Thinktank owns that equity tranche. That's all in the first mortgage position. It just gets split up into different priorities. So the way subordination works is the senior lender gets paid first. So all income is aggregated at the end of the month. It goes to the senior that they get paid first. Whatever is remaining goes, then the junior funder gets paid. Then the remaining tranche goes to the equity funder. And then the remaining funds are essentially the issuer's cash. That after all expenses, all investors have been paid, that cash is called the excess spread, and that goes back to the funder. So investors in our high yield trust, they take the senior equity or the second loss position in the debt capital stack. So it's not a case of there's no adverse selection or pecking order in terms of which loans get allocated to who, because all of the loans that are in that debt position, all investors are exposed to all of those loans. It's more around the subordination and how the waterfall payment of income operates, and you get the lowest return at the top of the debt capital stack, and because you're taking subordination and you're taking more risk, you get paid more as you go down the debt capital stack. The difference, it's the flip side when it comes to any losses or equity or capital losses. So losses start from the bottom and go up. So to answer the question, there's no adverse selection or pecking order. Everybody in that transaction is exposed to the same assets, and the senior lender, generally, they choose the credit policy. So other investors are pretty comfortable with the credit policy that senior lender has proposed. So whatever loans come across our desk that fit into our different funding facilities, that's how they get allocated, rather than Thinktank saying, well, we work with this investor, they give us lots of money, they get this best loan. It doesn't work like that at all. And in the income trust, all investors are treated the same, and they are exposed to all of the loans that are originated out of the income trust. So hopefully that helps answer how the debt capital stack works and that sort of subordination and priority of payments.
So investing alongside best-in-class investors and asset owners?
Obviously I'm biased, but that's our position. And high-yield trust investors, they're protected by Thinktank's capital. So Thinktank's capital is at risk of not getting paid income first, and the capital is at risk first. So hopefully private investors are comfortable that we've got skin in the game and that we're not going to actively write credit that could lose our capital. And we've been supported by the institutional investors since we started in 2006. And we issued our first transaction in 2014-15. So we've been in the debt capital markets for coming up to 10 years now.
Well, given that even though the nominal yields are attractive, people still will like, to support their standard of living into retirement, they would like that higher yield. I think you've captured perfectly some of the risk mitigation that you're thinking about and what role this can play. So thank you so much, Lauren Ryan.
Thanks, Laurence.